when others are fearful. And definitely now is a good time to be greedy. So stay invested. You need to manage risk. It's not the time to chase prices. We feel like there will be opportunities to buy them as they go down.
This episode was brought to you by Call Private Clients. To know more, there's a link in the description.
Good afternoon, everyone, and thank you for joining us today for our discussion of our views on the market. Let me start with my presentation today. So I'd like to start out by talking about how the market has performed. And well, for this year, after falling sharply to a low of 4,623, you can see that the market has rallied substantially by 36.6% to 6,315 as of last Friday. And you may be wondering what has changed to cause the market to rally so much after falling so sharply initially during the year. And well, to start out, the curve has actually flattened, allowing economies to reopen. And of course, we know that given that the worst is most likely over, you do have some possible treatments and vaccine currently undergoing tests right now, showing some promise. You have remdesivir, and then you have Moderna's uh, vaccine, and then of course you have the dexamethasone, and then of course finally, and I think most importantly, is that global central banks led by the US Fed is boosting liquidity, benefiting financial markets. So I'll talk more about the move of the Fed right now. So I think that's really what's leading the market higher. So as you can see, while the Philippines was up by 36.6%, the US was actually stronger, with the S&P 500 index actually rising by 39.2% during the same period. And well, one of the major factors, or the most important factor allowing the US to go up substantially, was the Fed. So as of last week, the size of the Fed's balance sheet is already $7 trillion. And just to put things into context, you can see that during the start of the global financial crisis, it was less than $1 trillion. And it took several years for that $1 trillion to grow to around 4 trillion. And from 4 trillion to 7 trillion, it only took maybe a month or two. So really, the Fed has been responsible for increasing liquidity in the markets. What else has it done? First, it has cut rates by 150 basis points to virtually zero. It has rolled out several programs to boost liquidity of banks and financial institutions. So what's new now is that the quantitative easing program is unlimited, and it can just buy as much treasuries as it wants, and mortgage-backed securities that are backed by the government. But another thing that's different this time around is that it can purchase up to 750 billion US dollars worth of investment grade and junk bonds, including bond ETFs. So in fact, it's starting to buy direct bonds. I mean, in the past, it has only bought government-backed bonds, but now it's buying everything. And that has been very good for the market. I'm sure you are aware, or you have read, how retail investors and day traders have become very popular in the US. And they have actually been mocking the fund managers because they have been performing better than the fund managers. And all thanks to the Fed's very aggressive move of supporting financial markets. Essentially, the Fed is trying to repair financial markets to help the economy recover. And that's actually helping boost the market higher. So why are we a bit cautious? Because we don't expect the PSEI's recovery to be sustainable in the short term. The reasons why include because we don't think that the economic recovery will be a V-shaped recovery, Rather, we think that we will see a U-shaped economic recovery in the Philippines and, in fact, around the world. Secondly, we feel that valuations are no longer cheap, even though we recognize that the economy has seen the worst. And finally, foreign investors have turned back into net sellers after momentarily buying Philippine stocks. Okay, so on the economy, why aren't we expecting a V-shaped recovery? So you can see here how our GDP growth actually turned negative in the first quarter, negative 0.2. And this is with 2 weeks of ECQ only. Second quarter, of course, it's going to be worse, given that we were under some form of quarantine. Right now we're still in some form of quarantine, and other areas are still under quarantine. So if it was only 2 weeks and we were down 0.2%, then of course the second quarter will be a lot worse. Okay, and these are just some of the GDP growth forecasts. So you can see that the global economy is expected to be in a recession this year. And for the Philippines, you can see how the view has changed. Early this year, we were projected to grow at least 4%, up to 7.5% based on our very own DBCC. But right now, the economy is projected to contract by as much as 4%. So that is the expectation. And one of the reasons why I'm not expecting a V-shaped recovery is because you will notice how the reopening of the economy is being done in phases, and it's very strict. The graduation from an ECQ to a GCQ, and then to a relaxed GCQ and the new normal, it takes a lot of time for it to happen. So it's difficult to immediately bring business back to where it was pre-ECQ. Okay. And how do you define the new normal right now? Well, when you go out, you have to wear masks. And then when you go out, um, you have to practice social distancing. So you have to be at least 1 meter apart with other people in public areas. Public transport is a challenge. And in fact, that's one of the things that the companies we talk to tell us that's an issue. For example, in the malls, they said they're allowed to open, but not all the stores open because their workers cannot come in. Even the construction companies are saying, well, they're allowed to construct. The problem is the workers cannot return. They are having a hard time bringing in people. Not everybody can do work from home, and it's a challenge. Again, malls and commercial establishments limit the number of people inside their premises. And, anecdotally, if you think about it, you will see, well, a lot of people just deciding to walk away because they have to line up before they can go in, maybe to buy something. They'd rather not do it, right? And gatherings to be highly regulated. So in other words, you won't be seeing a lot of parties. Church gatherings are not allowed. For me, I like joining mga marathons, so I cannot join a marathon for a very long time. So, it's not conducive for work or for spending money. So it's not good for the economy. And well, there are already indicators in the Philippines. For example, our unemployment rate shot up to 17.7% for the month of April. So putting things into context, 17.7% is actually a record high. And this is notwithstanding the fact that the labor force participation actually fell to 55.6%. So in other words, even though there were less people who were looking for a job or who wanted to work, the unemployment rate shot up so high. So in other words, if we had kept the labor participation rate at around the 60% level, maybe our unemployment rate would have been so much higher. According to the Office of Representative Stella Luz Kimbo, who is one of the proponents of the fiscal stimulus, 29 million out of the 41 million workers in the country are potentially at risk because of COVID-19. Okay. Another thing why we're a little bit cautious is the outlook for OFW remittances is quite bleak. As you can see, Different groups are projecting OFW remittances to fall this year. The most aggressive being Union Bank, which is projecting a 16 to 18% decline in the in OFW remittances. And well, this is something I just like to share because in a lot of economies, you will hear how the government is or their governments is doing aggressive pump priming activities like equivalent to 10% of GDP. Our government has been talking about stimulus program, but it has been criticized as not being enough. And if you look at this table, really, it's really not enough. They can talk about stimulus, but if you compare it to where it was before, it really is not. For example, look at the disbursements, the disbursements row here. So naturally, you will see some revisions. um, in other countries, the revisions is actually up because they spend more on COVID-19. What happened with the Philippines is actually, yes, they did spend a little bit more. There was a 0.3% change in our disbursement this year because of COVID-19. And there was some reallocation of spending from other items into COVID-19, which is fine, right? But the problem is if you look at next year, you will see how our government spending is kind of flattish. It's only 4.2 trillion. And then for the following year, it's less than 10% up. So the growth in government spending will be, in the past, the projected growth was around more than 10% per annum, but now the growth is very slight. And this is because you can see how the government's finances has deteriorated. Um, for example, the deficit to GDP from 5.3% initially. So initially, when during the month of March, when we first had COVID-19, the government said, okay, definitely our deficit is going to deteriorate because, of course, economic growth is going to weaken. But they were thinking we're only going to hit 5.3% deficit. But now they're projecting it to hit 8%. Um, and that is scary for them because our debt to GDP from around 39-40%, it's going to climb to 50% of GDP, and they're not comfortable with that. So if that's the reason why, if you watch the news and you watch our finance secretary talk about why he's against all this COVID-19 stimulus, is because he's worried about the deficit and he's worried about the debt. As you can see here, despite the fact that they're going to spend not a lot more in 2021, the deficit to GDP is still 6%. Our debt levels are still climbing. And the same goes for 2022. So it will take several years to pay back for the supposed stimulus that they're spending this year. And the finance secretary is worried about this. So can you imagine? I mean, when we were in college, we were taught that GDP is C plus I plus G plus X. Your consumers are not going to spend a lot. Businesses are spending less, planning to spend less this year. Exports, of course, are gone. Tourism, probably the same. So your only hope really is government spending. But then again, when you look at government spending in the Philippines, it's not very optimistic. It's they're actually going to spend very little. Okay, and reasons for weaker government finances, they'll have lower revenues because of the weaker economic growth, and there are plans to cut income taxes from 30% to 25%. Okay, and this year, of course, there's slightly higher disbursements because of COVID-19, and they will resume with the build program. So that said, I mean, yeah, we recognize that we've already seen the worst in the second quarter. And the reason why we are a little bit cautious on the market, I mean, you might argue, well, the market is a forward-looking barometer. So why are we so, focused on the past and what everybody knows, which is, well, it's gonna be bad. The reason why we're a little bit worried is because of valuations, because in our opinion, the market is pricing in a V-shaped recovery. So this is a PE band. So during the bad times, you will notice that prices will trade at lower valuations, which is around 15 times PE. During the good times, it will trade at 19.6 times, 20 times, 21, 22 times. Right now, because the market has gone up quite sharply and earnings have been adjusted downwards, the PE ratio of the PSEI is already at 17.7 times, or back to the mean. So, in our opinion, economic conditions still do not warrant us trading back to the mean levels. Okay, for example, earnings forecast, in our opinion, still face downside risk. So this is based on the first quarter earnings results. So every time companies come out with their earnings every quarter, we track how many companies deliver better than expected earnings, how many companies deliver inline results, and how many deliver weaker than expected results. And when they deliver weaker than expected results, of course, most of the time we try to understand why that happens, and we adjust the earnings downwards to reflect the worse than expected results. Okay, so based on this, you will kind of see that there are a lot more companies that disappoint and most likely will face downward earnings forecasts. Okay, and this is the EPS forecast for the PSEI for 2020 and 2021. So you will notice that for the year 2020, for COL, we have reduced our earnings forecast or EPS forecast for the PSEI index by 24% relative to 2019. Okay, but the global financial crisis, EPS actually fell by 27%. So there's a chance that we could still go down a little bit. Consensus is catching up. It's down 19% right now. But what worries me more is 2021, because as I've said, the market is forward looking. If you look at the 2021 earnings forecast, for example, consensus, it's 452. COL, it's 442. Compare it to 2019. 2019 is 459, COL 459. In my heart, I wish that 2021 would be back to 2019, implying a V-shaped recovery. But if you actually drill down to the details of the PSEI and you look at the different sectors, it looks like it's difficult to expect the 2021 to already go back to 2019. I guess you could ask the question with regards to properties. Do you expect the malls to be as full as they were in 2019 next year? For the banks, do you think they'll be as aggressive lending, or they no longer will have to set aside provisions? And will restaurants be as full as they were in 2019? I think um, the more obvious answer is looks like it's not going to happen yet. So there's a good chance that these forecasts will be revised downwards. And then foreign investors, I mean, the last few weeks were actually very bullish for the market. It went up sharply from 5.5 to 6.3, 6.5. And because foreign investors came in, and that was the story last year. When foreign funds came in, the market went up substantially. But when they left, the market went down. And while we were going up since March 20, you will notice that foreigners were largely absent. And after coming in the past few weeks, for a few days, they left again. So, it's difficult to imagine how the market can go up when foreign investors have not come in. Okay, what are the risks? The ongoing measures to contain the outbreak fails, and the virus stages a comeback, leading to a reimposition of restrictions or W-shaped recovery, which is what you highlighted as one of the key risks that you are most worried about. Second risk, development of vaccine and or treatment takes longer than expected. So the hope right now is that we will have a vaccine or a proven treatment by next year. Let's hope it really does happen. And I mean, the less risk right now actually is the aggressive monetary policies leading to sharp rise in inflation and currency depreciation. This is a more longer term risk. Okay, so just uh, food for thought on the vaccine. Usually it takes more than 10 years to develop. Right now, at least we're a little bit faster. We're doing the clinical trials. So let's hope that we can finish all the clinical trials faster and we get manufacturing and FDA approval right away. Um, but this is some food for thought on why it may be delayed. Um, there's also a chance that the current candidates do not get FDA approval because less than a third of those that undergo clinical trials get FDA approvals. Anyway, that said, that's why we are reiterating our strategy. We have a view that definitely, as Warren Buffett has said, be greedy when others are fearful. And definitely now is a good time to be greedy. So stay invested. The problem is we feel like, you need to manage risk. It's not the time to chase prices. We feel like there will be opportunities to buy them as they go down, which is why um, the fund is not 100% invested in stocks right away. Of course, we still recommend diversification, limiting the size, and having a long-term perspective when you buy stocks. And our preference right now is to stick to resilient sectors. Okay, so what are the resilient sectors in our opinion? We feel that the retailers of essential goods, such as groceries, food manufacturers, such as those that produce, say, canned goods, milk, and other products, would stay resilient. Telcos, of course, especially now that we have to do a lot of things at home. We do a lot of things online. We will need to use the telco services, data services, and utilities, power, water. I think they will stay resilient. The more vulnerable sectors, which will be the retailers of non-essential goods, such as maybe clothes, shoes, restaurants, because people will change their behavior for the meantime. Property companies, more specifically those that are in hotels and malls, and the banks, because they may suffer from higher non-performing loans. Okay, so that ends my presentation. Thank you very much. I'd now like to turn over the floor to Marvin Fausto so he will talk more about the strategy of the portfolio. Thank you.